reinforced some trends. The first one clearly with the low rate environment. If you think back to asset allocation years back, it was your standard 60-40 portfolio, be 60% in equity, 40% in bonds, and you're okay. Clearly that's changed the last 10 years with low yields, and now US is even at 0% yields right now. So that 60-40 portfolio already, private markets, whether it's private equity and real estate, we're increasing in prominence the last 20 years, but like in Asia, just growing, Angela's highlighting starting the last 10 years. But that's going to continue to grow because of the return potential. And what's interesting is you need to be paid for the illiquidity of private investments. But what's interesting is private equity, for example, has outperformed public markets the last 20 years against the S&P, which is by far the best performing public market, by 6% annualized. So there is that precedent that you get paid for that illiquidity. And that's going to be important going forward. Secondly, I'd say the macro context coming out of COVID, what we saw out of GFC, for example, private equity real estate firms outperformed even more. Why? They can inject capital. So for example, private equity, they invested more during 08 and 09 in working capital, market share strategy, other things. And those companies on average took 8% market share coming out of the downturn. And if you think about this crisis, it's different. Small mid-cap companies, not large banks, not other corporates, they're the most under pressure. Mid-cap spaces, which is going to be under pressure for funding as we come out of this, often are targets for both private equity and real estate.
I'll spend a bit of time on sort of the core private equity strategy, which is what we call leverage buyout funds, and all the sort of other strategies within the private equity or private market space, like growth equity, venture capital. To some extent, they draw some of their value creation model out of this, the same principles. In private equity or in leverage buyouts, private equity funds really use three main levers to create value for their investors. Number one, and that's how it's really started 30 or 40 years ago, is to use leverage. You buy a company, and obviously you don't put 100% of equity, but you use leverage at the company level to increase your potential returns in the future. I mean, today this is mostly considered, I would say, financial gimmick. As long as you have access to bank financing or capital markets financing, most private equity firms are able to do so. The second thing that you rely upon is multiple expansion, i.e. you try to buy at a low multiple, let's say 5 times EBITDA, and you try to sell your company a few years later at a higher multiple. Part of that is driven by luck, because the economic situation, where the markets are trading will drive the multiples at which you buy and at which you sell. Part of it is based on how you've transformed the company, which leads me to the third point, which is for us the most important when we look at a private equity fund and when we look at whether it's a good private equity fund, which is operational improvements. And what I mean by that is that unlike their fund managers that are investing in public equity, the private equity fund managers are able to have a significant impact on how the company is managed, and therefore drive operational improvements, whether it's at the top line, sales growth, whether it's costs, EBITDA, margin improvements, and so on and so forth.
Extending some of the key points made by Prashant, I think when we look at investing in real estate right now, I think it is right that we view this as a black swan event. Black swan events that should still be close to our memories include, of course, the 2008 financial crisis, the technology bubble of the early 2000s, and of course the 97 Asian financial crash. So in context and specific to real estate now, it is about investing to achieve two key objectives in QIP's opinion. Firstly, to manage downside risk, because in the short and medium term, we are expecting the world to be in a bear state. The downside risk of investing in real estate is the very physical asset that you hold as security or asset backed. And this is really the capital protection or the capital loss downside aspect of the investment thesis. Secondly, and Prashant has picked up some of these points, is to secure the predictable income and capital value in the medium and long term. In fact, because of the very black swan event that is before us.
Private markets is actually much interesting opportunity for the investor, especially the family office. Because for investor, it's much harder to invest in the private market if they are retail investor. But if you have family office where you have access to the deals, you have a very good access to investment opportunities, and you have a bigger capital deployment ability, you will definitely go to the private markets because this is where the opportunity go for. And also alternative can offer a lot of diversifications across different asset class. So they don't have to congested into the stock markets. They don't have to congested into the public bonds market. So they can much easier to divert the investment into different asset classes, and they can structure different portfolios to enhance the investment returns. So that's why because of all the reasons, even for ourselves, we actually more focused to move in the investment from the public market to the private markets.